think about it, there's still so much upside potential for e-commerce, and brick and mortar isn't dead just yet. As of the end of the second quarter of 2020, e-commerce only accounted for, and I'll put only in quotes, 16% of total retail sales. So there's tremendous opportunities for growth ahead. And we believe that Q2 earnings showed the strength and the confidence of the U.S. consumer. And in all likelihood, they're going to continue to spend this back-to-school season and this holiday shopping season. And in all likelihood, they'll take advantages of the convenience, the cost efficiencies, and the relative safety of shopping online.
Kevin, what are some of your biggest concerns in terms of e-commerce? What sort of risk factors are you looking at?
I think it all goes back to really the Federal Reserve at this point in time, because we believe at this point in time, the Federal Reserve is likely to sit on their hands for the balance of 2021 and 2022 with respect to interest rates. We do believe that they will announce their tapering plans by the end of this year, in all likelihood starting to enact and cut back on their bond purchases at the beginning stage of next year, and then ultimately slowly starting to unwind their balance sheet at the end of 2022, leading to a potential hike in interest rates or two in 2023. If that timeline is moved forward, well, that could cripple the confidence of the U.S. consumer and have an impact on their online spending habits and their spending habits overall. Remembering, of course, that the consumer accounts for 70% of GDP in our country. So we need the consumer to spend to allow the economy to continue to grow.
Kevin, given how far stocks have come, is this still a good time to invest when you look at valuations and other market measures? Is it still a good time?
Great question, Tyler, as always. And if you look at valuations right now, they've actually become slightly more attractive. Consider at the end of 2020, the S&P had a PE of just under 30 and went as high as 32.5 in March of 2021. But now it's below 27. And that's not because prices aren't rising, because we've had 46 different days of record closes thus far this year, but it's because of earnings strength. So we believe that those attractive valuations present additional upside potential if the Fed continues to remain dovish and the federal government continues to stimulate the economy.